Welcome on this show. Reliance Nivesh Lakshya Fund, the latest NFO from Reliance Mutual Fund, is all set to launch on June 18th. I'm Himadri Butch, and with me is a very special guest, Harshvardhan Rungta, who is an independent financial advisor, and he's here to talk on investment in debt funds and also on the latest NFO from Reliance Mutual Fund. Welcome, Mr. Rungta. Thank you for joining us.
My pleasure, Madhuri.
Mr. Rungta, what is your view on the debt market, with interest rates rising? How do you think investments in debt would be beneficial for investors?
Well, Madhuri, if you look at what investors have gone through in the last 1 year, where we've seen the yields move up almost 150 basis points, well, it's been quite disappointing for debt investors as of now. Now, but does this mean that we should shun the debt investments completely? Well, not really, because if you look at the asset allocation of individuals, debt forms a very important component.
Correct.
So, if we divide the investors in two categories, one being investors who've been invested since about a year in debt funds, well, it's been a bad time for you. You're looking at a returns of almost about 2 to 4%, even in income funds. So, well, our investor will definitely think that, what was the need for me to get into debt funds? I could have been in fixed deposits and earned more.
True.
Well, now if you look at the another set of investors who would be getting into investing right now, so you're looking at a yield of about almost 8%. So this is a time when you would possibly want to get in and try and make sure that you lock in your investments at this time so that you do not run this risk of reinvestment.
Correct.
So I think it's a moderate look. From an asset allocation point of view, you need debt in your portfolio. Within that debt category, what are the options and which are superior products? Well, that is where the discussion would start. Is it a fixed deposit? Is it mutual funds? So that's where I think investors would need to start looking at now.
All right. Also, Mr. Rungta, if you can tell us, how this latest offering from Reliance Mutual Fund is going to be like. What is the USP of the fund? If you can just elaborate a bit on that.
Yeah, so taking cue from what we've seen investors go through in the last 1 year, wherein we've seen a rising yield scenario. So if had you been invested, and if you're sitting and looking at returns right now, you're looking at negative returns.
Correct.
Negative, I mean, because you're looking at about 2 to 4%, you've not even beaten inflation. Now is the time when you're sitting here, and I as an investor would think, I have yields right now at about 8%. Do I think yields will go up further? Not really, because in a growing economy, if yields tend to keep going up, then we're contradicting ourselves.
Right.
So if India has to grow, the yields will come down. And that's historically been the case with all developed countries.
Right.
So how do I invest right now and at the same time make sure that the 8% yield that I'm looking at, I freeze into that for a long period of time, because debt is always going to form a part of my portfolio.
Correct.
So with that context, if you look at this particular offering, it sounds quite interesting. The reason why, because the fundamentals are that you're going to invest into long dated gilt papers. Current yields are about 8%. And if you're going to hold it till maturity, I know for sure as an investor that I will continue to get this.
Right.
In the interim period, from today till possibly 20, 25 years from now, yields could come down, go up again. But if I'm holding it till maturity, I don't really need to worry about these fluctuations in the yield. So if I were an investor who's burnt my hands in the last 1 year in a debt fund, and I don't want to go through this again, I would want to lock into my investments and look for yields which are going to go on for a longer period of time. So this fund essentially comes out with that objective of investing right now, holding till maturity, which is then in the interim, if the fluctuations happen, it is immaterial.
So which are the target investors you will be looking at? Does it cater to investors with an appetite from low to 0%?
No, so actually, if you look at an investor's portfolio, we've always been advocating asset allocation,
Right.
irrespective of your age. So what happens is you will need to divide your money into equity, debt, in different asset classes. A younger person would allocate less amount towards debt, and an older person would possibly allocate more.
Correct.
So the spectrum is going to be across all different age brackets. However, the quantum is going to be different.
Right.
So it applies to all investors because in all points in time, you're going to have debt allocation.
Right.
Now, what's interesting over here is that if you are planning to invest into debt and that forming a part of your portfolio forever, and ever means long term. Now, long term, you're talking about 20, 25 years.
True.
Unfortunately, all the debt products which have been constructed right now have a period of about 2 to 3 years. What happens after 2 and 3 years? When you come back to reinvest
True.
and that time the interest rates are down, then you'll have to reinvest at a lower rate.
Yeah.
So this product would essentially apply to all categories of investors
Correct.
who intend to have debt as a portfolio in their portfolio for a longer period of time.
Correct. So what's the purpose of investing in long dated papers, GSECs rather?
Okay, so if I may highlight the advantages in particular, well, if you have invested right now in GSECs, first of all, so GSECs would be the most safest options that we're looking at.
Obviously.
I mean, you're not considering a government to default on payments to you. I mean, that's not going to likely happen. You may have the best of corporates going under re-rating. The credit rating might be going up or going down all the way. But GSECs, you really don't have to worry about default risk at least. So that part is clear.
Okay.
Now let's look at the other advantage, which is the locking in of your interest rate for a long period of time.
Correct.
So if I'm an investor, I invest right now, the fund tells me today itself that the intent is to invest into long dated papers, gilt funds, gilts, and they're going to hold it till maturity.
Okay.
So that gives me comfort into saying that, in the interim, I might see interest rates going up, if at all. So that will entail a loss onto my portfolio. That would only be an NAV difference.
Correct.
But if I am not going to redeem, nor the fund house going to redeem or sell, then this is only a book entry.
Correct.
So eventually I'm going to earn 8% as an accrual on my portfolio.
Right. So like you mentioned, these papers would be for 25, 30 years and would yield around 8%. Don't you think investors, by then would move to a better offering returns or like equity funds or something like that? Don't you think so?
Yeah. So now when we come back to returns, I mean, now we're boiling down to the fact that if I'm looking at an 8% yield minus the charges, of course, I'm looking at about 7.5 kind of net yield to an investor.
True.
If I'm planning to invest for 20, 25 years, is equity a better asset class? Now, this is always a discussion point because equities over long term do definitely give higher returns.
Yes.
But we've also spoken about asset allocation, if you remember.
Yes.
We spoke about asset allocation, which means at every age point, you will want to have some portion in debt. So it could be, for a 20-year-old, it could be possibly 20% in debt.
Yes.
For an 80-year-old, it would be 80% in debt.
Right.
The question is, what do you do with that debt allocation? So a 20-year-old also needs to put money into debt. Now he could put his money into fixed deposits as an option. But if you look at the tax efficiency of a mutual fund is much better because of 3 years, beyond 3 years, it becomes long term and you get indexation benefits.
Yes.
Look at liquidity. I mean, if a person wants to withdraw money at any point in time, now if you are in a fixed deposit and if you've booked your fixed deposit for say 10 years, for example, okay, and you want to prematurely break it, there is a penal charge that you have to pay. In this case, though it will be on NAV basis, but there is absolute liquidity. You can go and absolutely redeem your money. If you're looking at regular cash flows, for instance, okay, fixed deposits, you could choose a monthly, quarterly, or a yearly interest payout. Now, well, that monthly, quarterly, yearly interest payout is fixed, whether you require it or you don't require it. In this case, you can set your own payouts, the payouts that you receive. You can set up an SWP, which is specifying a specific amount that you wish every month. Now, this works with retired individuals as well. If you're looking at regular income, you could park your money over here and set up an SWP. So, all in all, the underlying highlight, if I may have to say, would essentially mean that this is a hold till maturity paper. So I know as an investor, you're locking in your money for a longer period of time. So that kind of works well in this arena. And as I said, within the debt category, not many funds have these kind of clear mandate that they will hold till maturity. So there is always a reinvestment risk. There's always an interest rate movement risk, which is kind of mitigated in this concept.
Mr. Rungta, would you look at investing in other AAA rated bonds which give around 8.75 kind of returns in 3 to 5 years?
So, well, Himadri, if you're looking at an investor's portfolio, you would have a AAA rated bond in your portfolio. You would want to have gilt in your portfolio. So we're not looking at either or. It's not that you're going to invest only in AAA rated. It's not that you're going to invest only in gilts. Well, it's going to be a combination. So when I look at a AAA rated portfolio, I'm comfortable with it because it does give me a higher yield than the GSECs. Well, but do I have a risk of it being re-rated downwards? Yes, I do. Do I have a continuity option which gives me about say a 20, 30 year time horizon where it freezes my higher interest rates? Well, I'm not too sure about that. So as an investor, you will have a combination of both. And within the gilt category, I draw comfort from a fact that I have a paper which is actually going to go on for about 25, 30 years and freezes onto the higher yields that I enjoy today.
Mr. Rungta, usually long-dated GSECs are interest rate sensitives with RBI hiking interest rates. So is the case with Fed. Don't you think investors have the appetite to digest such fluctuations?
So, well, what happens is when you're looking at an interest rate hike, so we've seen one today, we've just seen one recently. There's a great possibility that we will have another rate hike in this financial year itself. And this is definitely kind of going to scare the investors. But nevertheless, I mean, as I said, we're looking at a long-dated paper, hold till maturity. The concept being hold till maturity. So if a fund house is going to hold the paper till maturity, in the interim, if you see the fluctuations in NAV because of interest rates going up, that is only a notional entry. It's not really a booked loss to you. And since you're going to hold on till maturity, I don't think you should have much to worry about it essentially.
All right, Mr. Rupta, great to have you on the show. Thank you for all the investment tips and insights.
It's my pleasure. It's my pleasure. Thank you so much.
So Reliance Nivesh Lakshya Fund is an apt fund for investors who are looking for long-term investments in debt fund category.